Yeah, thank you, Valerie. Thank you, Joseph. Appreciate all you guys for joining us here on Friday morning. Happy Friday. I'm joined here. William Givens is a colleague of mine on my team, so we're kind of tag teaming this. We have a very tight team of six that we're always in the office with, so we always collaborate on really everything. Um, and I thought it would be helpful for him to speak to times that kind of precursor when I joined the team as well. Um, we are at Colliers on the debt and structured finance side, debt brokerage, that is. We're a team of six, as mentioned, here in Dallas, out of their Dallas office. We came over from CBRE 2 years ago now, where we before that, had our own firm before Seabury bought us out, but have since moved on and are led by other team members, Sean Givens, Robert Siddall, Will, of course, and then have a analyst with us here next to me, and then a closer out in St. Louis. We are used to a high number of deal volume per year and close on a good year anywhere up to 225 to 250 deals. We cover all asset types, all loan amounts, and have closed deals in all 50 states. So we're pretty seasoned in knowing how to underwrite most, if not all, asset classes. I think when I came on the team, the first deal that I saw that we were dealing with at that time was the three out of the four naval shipyards in the United States. So just to give you an idea of what we are willing to look at and take on in terms of size and complexity, that's really just to give you a good reference on that. But this has been coming to SEBA here for a couple of times here now, and it's a wonderful way to network, and had a great time meeting some of you guys that first time, and thought Will and I could share some knowledge and help all of you out with your commercial financing and what you're willing to, or what you're interested in purchasing through what you gain out of these types of classes. All right, and then I've got one to bring you through. We've got an example term sheet here that we just received May 28th. And Will and I just wanted to talk you through, kind of bring you down. And as you'll see, it's a largely redacted because of sensitive information. We just didn't want that to be out there to the public. But it does have some good, valuable information here for you guys that we thought it would be helpful just to briefly discuss, and throughout that, generate more questions that you guys can ask us following everything here.
Can I jump in real fast?
Absolutely.
Yeah, I think it's important to look at a live term sheet or letter of interest. Same thing. Most investors, if you haven't done a deal yet, you would have not seen one of these, and you will not have understood the purpose and or how important these are, and really kicking off the process of acquiring a deal. Now, this is specific to a very triple net single tenant deal, but applies to every single deal out there. They all look a little different from each bank and each lender type. But instead of just hypothetically going through what we do on a day-to-day or how we can add value or bring some knowledge, we thought it was really key here to walk through a very live deal and get questions on it. And Bryce will walk you through that. But I think it's important to note, again, live deal as of, you can see the date very recently, that should hopefully get signed up here to apply tomorrow. Sorry, Monday. And yeah, when
Perfect.
we walk through this, when we're finished, feel free to ask questions, or you can throw them in the chat if you'd like. We can hit them one by one. But Bryce, if you want, kind of go through
Yeah.
process of how you get a term sheet maybe first,
I
and then
was yeah, I was about to shed light on that. That's a good point. Yeah, so basically, thanks, Will. Um, basically, uh, you when you have identified a property that you would like to purchase, proceed with, whether that's using a broker or not, we'll all get together. You will we'll get on a call or have an email chain, extensive email chain of, hey, this is the property I want to buy. We'll request all the information necessary, pertinent information for that property type. In this case, like Will said, it's a triple net deal. So really, we're looking for an OM, um, a lease. I would say are the two main things, and then maybe a purchase price that you're looking to offer on the property, or an LOI or PSA if you're already at that stage. Um, at that time, we'll take the deal with all of the requested terms that you're looking for, a 25-year amortization, a 3, a 5, a 7, or a 10-year term. However, those are just examples. What rate range you're looking for, um, are just these are just examples of terms kind of that we see non-recourse as opposed to full recourse. Flexibility on the prepayment, which allows you to refi or sell the property at a later date at either an added cost or lesser of a cost. Allows more flexibility with just decision making generally on the ownership side. So we'll take all that information, we'll put it in our package. We'll make sure that there isn't anything left out. We'll on at times get most times get personal financials, in indicative terms of, hey, this is where net worth and liquidity are for you as a buyer or a borrower if it's a refinance. And we'll put that all in a package along with an email summary, very detailed um, process. And we'll shop that out to several lenders. And I say several because at time, I mean, we just shopped a deal out to, was it 250 lenders or
yeah,
300?
240.
240.
This specific term sheet was about 50 lenders, and this was one of the best ones that came back for that deal.
Mm-hmm. Mm-hmm. And so at right, the number of lenders we will shop it out to is definitely dependent on the times. We're obviously going to keep shopping it out until we find that lender that matches those requested terms the closest and or hits it right on the head. uh, but in like a few years ago, we would send it out, send a triple net, say CVS or CVS portfolio as well. We do portfolios as well. Um, and we would send that out to 10 to 20 lenders, and we would have 8 to 10 term sheets in return that would all be competing against each other. And today, that has changed drastically, and it obviously lending has tightened up. Um, Parameters for banks have become more restrictive, more strict on their lending programs, or they're shutting their doors completely. So we're losing these avenues. So right now we're seeing we're having to send it out to, you know 5 times as many banks, and we'll be lucky to get 3 to 4 term sheets back. And so it's definitely probably the most important time, if you are in the market to buy, to be utilizing a service like this because relationship lenders are great. It's all dependent on what that relationship is, how long it's been, what that looks like. But if you're a first time buyer of a property and you're not looking, you don't know what you're getting into and how complex and what costs are. We're very helpful on the side that we really hold your hand through that process, and have a wide um, range of lenders, both in the banks and credit unions, but also on the CMBS. We're direct Fannie lenders, with a desk license through Colliers. So we have access to that agency, that is, but also send it to Freddie as well. Really, all different types of lending depending on that deal structure. And we can go through that later if y'all have questions about that. But we probably have up to 5,000 different lenders in our pipeline that cater towards one corner or another of one of those deals I mentioned. So not to be long-winded, when we do shop that deal out, a deal like this that you're seeing here, um, we'll shop it out with those requested terms. We will get responses, whether that be questions about the property itself, about the buyer or the borrower, get those answered, those lender questions answered, which hopefully more times than not lead to indicative terms, a soft quote. We'll combine all those soft quotes we get from all different types of lenders, combine them into another document, quote flyer, that shows every line item broken down, the terms that they offer at the purchase price, at the loan amount that they offer, and leverage, and put them side by side for the buyer to then compare and contrast and see which one. Hey, I want to go with bank one. I want to go to credit union one. Tell me a little bit more about that. We'll jump on the phone with you. We'll discuss those a little bit more detailed. And once you've decided to proceed with one, we'll request a term sheet from that lender, and that is what you're seeing here now.
I have a question.
Yeah.
Who is setting the initial terms? Is that the buyer or is that you guys? And then what are you seeing kind of push deals through? Because you said a lot of people are kind of coming and going. Some lenders aren't lending anymore. So, because I know a while back it was like, hard money up front, larger earnest, like there was different pieces that became more competitive than in the past. So on the lender side right now, what are you seeing that's being more is experience? Like what's pushing these banks to actually accept terms?
Mm-hmm.
To be able to get a deal through, what would we be looking at?
Yeah, so on your first half of the question, the side who's sending the initial terms, right? The buyer's request or the borrower is requesting those terms, and then we'll shop those requested terms out. But what we get hopefully in response is those terms that the lender is willing to offer as a response to what they're being requested, what the buyer is requesting. So that's the information that we're getting back and that we present to the buyer at the end of the day, at the end of the week. Once we have a few quotes, we'll call them, we put them all in a quote flyer, and then we let them compare and contrast. And then on the second half of your question, I would say for a lot of our lenders, I would say to get ahead of the hiccup that is presented when a number of lenders shut their doors or they change their program structure to include this, but not that anymore. But this was really competitive back in the day. We just stay on top of them. We call them. We are constantly calling lenders and getting program updates. I have 10 programs to update as of yesterday because I would just be shoveling out, hey, like, what are you doing here? What deals are you winning? What can you get most competitive on? Are you offering non-recourse? Okay. What's your minimum loan? So all these questions, they accumulate. There are a lot of questions because we have a lot of lenders.
We do.
But it's all about finding the most creative uh, results or most creative solution when you're faced with, hey, we've stopped lending. You're like, okay, well, we need to go find somebody else. Hopefully, at that point, you have 5 or 10 prospects of people in that area of lending that you want to hone in a little bit more on and find the new program updates from those. Or we've seen several times um, bank structure programs based off of advice we have given in the past. Now, these are preferred lenders of ours, and we have good relationships with them. Um, Thus, have a good influence when talking to them on the phone. They're our friends. Um, so it's just a matter of staying in touch, really, and being like tight communications. Will, what would you say?
Yeah, I would say kind of to add what Bryce is saying, just sum it all up. We have 1,000 best friends that we constantly have to call and check in on. What maybe Bryce is trying to portray as well was the market is very volatile right now. It's tough to find options on certain asset classes that were very easy 3 years ago, 2 years ago, kind of right after COVID in late 2020 through 2022. Lending was very healthy and very easy to get good terms. And then as rates ran and have stayed high, the Treasury specifically, along with Prime, it's become much more challenging. And a lot more banks have pulled out of the market because they don't know how to lend in this environment. So it is, again, most of our time is spent speaking to lenders daily. I mean, we're probably 30 to 40 every day, just checking in on them, see what they're doing, what their credit team's saying, how they're changing, all that.
Yeah.
Yeah.
Does anybody have any questions so far? Any other questions? And Valerie, did we answer yours?
Yeah. I kind of have one more question. I don't
Mhm.
know if there's any truth to this. I'm always really curious that at the beginning of the year, banks have more money to lend, and by the end, they get tighter and tighter and tighter. I know the market has a piece of that, like, controls a piece of that as well. But is that the case where at the end, lending gets a little bit tighter because the funds allocated for commercial goes away, or not? Is that
Yes
just an
and no.
investor?
I would say yes for some asset classes. So obviously we do a lot of retail and currently shopping a lot of CVS's and drugstores. A lot of our life companies that we go to for those types of assets are allocated and they're full. Where multifamily, we do a ton of apartment complexes, and that's probably what I invest in. That and self-storage the most. And Fannie, Freddie, other organizations are very below their budgets of what they were planning on hitting just because of the market. And so a lot of them have a lot of capital still. So I would think it depends, is kind of the answer, the accurate answer.
No, that's good. Yeah. I think it's that, right? Investors always wait till the end of the year because they got to get it in before for
Taxes. Yep.
purposes and stuff.
Yep.
And by the end, your terms start to be not as fair because, people have been buying all year long. So
Yeah, Valerie, as a former banker myself, banks get tied up in the asset class. They may have concentration issues. It's not necessarily a volume based on the time of year, but it's a concentration based on the asset class, like William's talking about too.
yeah. No, that's
Hi,
good.
can I ask a question, Valerie?
Yeah.
Yeah, this is TJ in Dallas. Thank you for arranging this. What are you seeing? What are you guys seeing in terms of transactions today compared to a couple of years ago? And how to get by with that? I mean, when we are underwriting a deal at a, let's say, 6 cap, and I'm having an interest rate at 6.5 and low LTV, how can I make that deal work?
I think you kind of answered your question with your comment, it's really hard. It's very challenging right now to make deals that are priced aggressively still based on interest rates to pencil. We have a lot of investors on industrial product, especially that are negatively levered because those cap rates are, I would say, the tightest of all of them. So it's tough. And a lot of our investors that maybe did multifamily or did industrial that are looking for yield have moved to different asset classes to get more yield, right? So retail, we've mentioned that a few times, but retail's cap rates are very healthy and have corrected, oh my gosh, 2020, end of 2020, We were doing some retail at a 5 cap, even high fours. Now we're doing things at 6.5 to 7.5 cap rates.
I'm
So it's a
quoting
big,
I'm quoting
big,
Starbucks for 9. Yeah,
yeah.
or
And so yeah,
Starbucks and Walgreens.
shorter lease deals are in that kind of 8 to 9 range cap rate wise. And when your rates low sevens, even high sixes, depending on the treasury, that's a very healthy spread between your cap rate and your interest rate. And then, yeah, TJ, to answer your other question as well, on multifamily specifically, other groups have moved from, let's say, Dallas to more like Tyler, Longview, and there is a lot of distress in the multifamily world. If you know where to look, there's a lot of bank-owned properties right now that we see. There's a lot of clients that we're helping workouts with workouts, apologize, and also helping them try and refinance their debt. We probably have about 400 million right now of debt we're working on to refi from their floating rate debt to a perm. So a lot of distress out there. You just got to know where to look.
Yeah,
Hey
well said.
guys,
Hmm. Okay, so I thought now would be probably a good time to go through the term sheet and just skim through some of the things that I was discussing in my outline here prior. So just to bring everything to life and apply it to a real life term sheet that's active, I would say. Um, so you have, you know, the address of the property, the who the term sheet is addressed to. Of course, we wanted to not disclose all this information to you guys or to anybody as it is confidential. So forgive us. But um, then you get into the proposed terms down here. Um, you have the guarantors, so those who will be responsible for the loan itself. Now, this can be non-recourse, it could be full recourse, partial recourse, and really all that when you hear recourse, all that you should be hearing is liability. And if it's partial liability, full liability, well, let's start with none. So if it's non-recourse, the lender can only go or will only go after the property itself that is under the collateral. They'll only go under the collateral. Um, however, if it's
I'll add to that, excluding bad boy
yes,
cards.
that's correct. Yeah, bad boy carve outs. If you're in fraud, if you lie on your personal financial statement, um, if you have high level no-nos that you are trying to almost trick the bank and lie about, then they will go after everything. Though that non-recourse will be uh, no longer. So uh, proceeding here, like I said, this is a triple net deal. So here you have a section about a tenant and all that is to be encompassed by that. The loan amount, of course, stated here. Now, some lenders will, per our discussions just recently, TJ's question, Valerie's question, some lenders will have updates to their program that are a lot more restrictive. Um, they they will have minimums to their loan amounts. They want to make sure that they're getting a fee that's worth it for them, worth their time. So we've been seeing that a lot lately. They're raising their minimum loan amount for a lot of our deals, and I would say on the bigger deals, those have been probably the biggest hurdle to get by, and just keep following. Hey, who has what minimum loan amount? So in this case, we found a credit union that was able to dip below the $1 million minimum that a lot of our lenders do have. Of course, when you get in the bigger life companies, they have 5 or 10 or even 20 or $50 million minimums, which we reserve for the bigger deals. Will, do you have anything on that?
Yeah, so client of ours is in a 1031 exchange. We're happy to go into more detail on what that means if you're not familiar. They have a very large down payment that they have to satisfy their exchange on. So this deal is like 26% LTV, so extremely low. I would say most of our deals are in that 65% range right now. So obviously a little bit of an outlier, but wanted to also disclose that. That's why the loan amount's so small. And typically our minimum is $1 million, but we'll go below for the right deal. This is a credit rated tenant or close to, which makes it a little easier as well.
Mm-hmm. Mm-hmm. Yeah, good point. Yeah, Will's been working. This is Will's deal, whereas I'm on some others. So that was a good point, Will. Interest rate here, you'll see, I would say for the average retail triple net deal currently, depending on the tenant and what status of credit they have. For example, if it's a CVS, Starbucks, 7-Eleven, they have exceptional credit in the eyes of a lot of our triple net lenders, and so they'll be given um, less of a look in the volatility sense. So our lenders will be a lot more comfy with them. They'll want that type of credit on their books, and so they'll be more competitive in that area. And so I would say in the general, all of our lenders, not all of them, but a lot of our triple net lenders are going off of the treasuries. And I would say the 5-year money is probably the most popular right now. 10-year, the spreads for 10 years are a little bit more high. Lenders don't want properties on their books for that long right now. It's not as attractive as it was a couple of years ago for them. And so I'd say 5-year is the most competitive term that we're seeing lately, and that is dependent solely upon how many years left remaining on that lease there is. If there's 4 years, they will not offer a 5-year. If there are 9 years left on a lease for a 10-year term request, they will not offer 10 years. Now we have some lenders who will go down to 3. There are a few of those, and the 3-year treasury is a bit competitive on the pricing side, so that might be a little bit more expensive. But like I said, 5-year is the most sought after right now for a lot of our clients.
To add to that, 5-year is usually most sought after because of the sentiment in the market. Most investors think rates will go down over the next 5 years, right? And so they don't want to be locked into a 10-year. In this example, it's not relevant since there's no prepay penalty, but they want to be able to refinance with no penalty if they do have a penalty in their loan around that 3 to 5 year mark, which is, I would say, the biggest driving factor of most borrowers choosing a 5-year versus 7 or a 10. And on this term sheet specifically, most lenders will provide 2 options. They'll say, hey, we're willing to do a 30-year AM or a 25-year AM. What you're not seeing here, which is a conversation that's happened after we've submitted this term sheet to the borrower, is they've actually requested that the amortization be pulled way down to like a 7-year AMO. So we're probably going to do a 7-year fixed 7-year amortization. So it'll be a fully amortized loan, which is not common for us, I would say. Most investors that buy deals like this are looking for cash flow. And in that structure, you wouldn't have any additional cash flow. You would just be paying the property down very quickly, which is, of course, borrower specific. So if that's what you want to do, if that's what your investment thesis is, then we will structure accordingly based on what you say. But most clients want the longest AM, the lowest rate, and the fixed period to match either a lease term or their exit period for multifamily. A lot of guys are wanting to exit in 5 years and sell in 5 years, so they wouldn't want a 10-year.
Right.
So, gentlemen, this is the credit union's term sheet to the borrower, correct? Versus not your term sheet to the borrower.
Right.
So
Credit union.
What are your terms typically what is your fee that you're adding on?
So we're typically a 1 point. Yep. So a pretty industry standard. And in this scenario, they came to us and said, "Hey, we have 15 banks we've spoken to. Best rate we have is like a 7.5 to 8." And so we were able to very easily improve our fee just because of the savings with the rate versus what they had when they came to us. And these specific individuals don't want to do much. People come to us, I would say, either when they can't find something in the market they need, or if they don't want to deal with doing the debt. We are the easy button, right? We'll take care of everything from start to finish. That's what our team does. So it's another reason why people come to us and pay our fee. And we're in their corner. We work for the borrower. So there are many times lenders either have things in their term sheet that aren't standard. They're standard to that bank specifically, but not to the market. And so we can speak to that as well and save money and time often.
Mm-hmm.
Our loans are closing in that 45-day mark, which seems slow. I would say 2 years ago that was like high 20s. But if you usually on average we're seeing if you go directly to a bank, you're closing in that 60 to 75 day. So we usually do it in 20 days sooner as well, which is relevant for a lot of these exchange buyers because they have timing constraints
Mm-hmm. Mm-hmm.
and of course contracts.
I know your minimum you like to stay above 1 million, but you can go under for the right deal. But what do you have a maximum size or your sweet spot that you try to stay?
So our saying is always we're 1 million to 1 billion, right? So I think our largest loan we've done is that 380 million mark. Not because we can't go bigger, we just haven't seen it. I mean, we've looked at some shipyards that were in that 500 to 700 mark, but they didn't end up closing. So
Yeah, it's quite the deal to be introduced to the team too.
no minimum, the deal size.
So on this, for the prepayment penalty, since this is a credit union, credit unions will notoriously offer no prepayment penalty on their terms. They will more times than not be full recourse, but that's totally dependent on the leverage. So usually if you have it's different for every credit union, but sometimes 50 if you go 50 to 55, that's still in that non-recourse range. If you go 55 up to 65% LTV, that is that would be kind of more on the, hey, this is an auto switch to full recourse because due to the increase in loan amount that we're giving you. So on the recourse side, dependent on leverage, it could be non-recourse or recourse, but prepayment penalty, they're notorious for having none. So that allows you to refi the property whenever you want for a lower cost than you would get from an average bank per se, which would most likely charge you a step down prepayment penalty of I'm just giving a hypothetical. If we're a 5-year term, a 5, 4, 3, 2, 1, that's 5% in that first year that they would charge you, 5% of that remaining loan balance. 4% on the second year, 3 on the third, 2 on the fourth, and 1 on the last, with around usually about 120 days of open period right at the very end of the term for you to freely refi without any cost. But at times, depending on the deal, the terms might be different for a bank as well. However, for a credit union, they will never charge you the prepayment penalty. Collateral, it's what makes our lenders super comfy to do the deal in the first place. And that's what they would fall back on, even if it were non-recourse to obtain from you. Loan to value is what I just mentioned. It's that ratio of equity to loan. So in this case, 30% LTV, that's not much exposure for that bank or the credit union. So we're likely similar to what I was about to mention on how competitive the rates are here. that when you get a lower LTV, you'll most likely see a lower rate, or somewhere else, if not rate, then somewhere else in the terms as a little bit of a incentive to make their program more attractive to the buyer. Then Will, do you want to take them through debt coverage?
Sure, yeah, happy to. Feel free to let us know if you want us to get more granular here. We live in the capital stack daily, as I'm sure there's a few ex-bankers on here, so I'm sure they do as well. But debt coverage is based on your net operating income on the property, based on a few underwriting criteria. Every bank has different criteria, especially on a triple net deal, which on a triple net deal, there's typically no expenses. On a true triple net deal, there's no expenses to the owner of that building. That does not mean that lenders won't put in, let's say, some vacancy in the underwriting or even a small management fee just to shock that a bit. We will also have some lenders throw in, instead of a 30-year AM, which is what they were offering on the previous page, they will underwrite to a 20 or a 25-year AM just to see where it covers. And that's what will limit their loan amount. Every lender's a little different on how they feel comfortable underwriting the NOI and getting to that final loan amount. So in this case, we had a 1.40 DSCR, which, again, we were such low leverage here. We were not even close to that. We ended up getting on top of that at a 101 DSCR, simply because the borrower wanted a 7-year amortization. So they wanted to pay the loan off in 7 years instead of 30, which was what they wanted specifically. So in this case, or in most cases, we are a 125 to a 130 DSCR. Any questions on that? I feel like that can be confusing sometimes. Often borrowers come to us and go, hey, why? Why is this a 130?
So DSCR is the net operating income divided by the loan amount.
Interest rate. There are a lot of things that go into DSCR and how you get there. We have a basic calculator that gets that there. But I would say the DSCR is important because in this case, they want the income to be 40% greater than the annual debt payment, right? Which is why it's a 1.40, or a 125 would be 25% greater than the annual debt service. But yeah, typically we use a basic calculator to fill that in. There's multiple data points.
Yeah. Anybody have any other questions?
Yeah, what are you seeing in the market now from a debt service coverage requirement? The 1.25 used to be the standard, but we're seeing it move.
It depends. So agency on multifamily, we're doing a 120, 125 for strong markets still. I mean, we've quoted deals yesterday at a 120. And then on retail, self-storage, we're probably a 125 to 130. This is the reason why this is a 140 is because it's not important. They maxed theirs out simply because it looks better when they go to credit committee. When the actual DSCR was, I think, in that like 1.9, almost 2.1 range, simply because we were so low on leverage. But most of the time, I would say our average DSCR is that 125 to 130, leaning more towards a 130 on retail. And then the more tertiary you get, the higher that request typically is. But multifamily is almost always a 125 still that we're seeing. I'm sure there are some bank options out there that they're doing a 130, but people typically don't come to us to find average. They come to us to find something that isn't in the market typically.
Mm-hmm.
Yeah,
And
I was curious what you thought this term sheet was attractive, because if you got a 140 debt service coverage at a 30% LTV and you've got recourse, what was the benefit to the borrower here?
So the outliers here on why this was attractive was rate, obviously a 6.65% rate. It's like a 214 spread over the treasury, which is extremely aggressive today. We're seeing, 2 years ago that wasn't as aggressive. especially with the lease term. Obviously, you can't see the lease term in this term sheet. It was shorter, which made it a little more challenging to shop. And then the borrower structure, which you obviously can't see here, and one of them was a foreign citizen, which complicates things a little bit. So there are obviously in a term sheet you don't see the whole deal. There are some complications that were brought to this deal, but I think rate for her was the most important. Obviously, her leverage request came to us. She wants 26% LTV. She's in a 1031 exchange. She didn't ask for max leverage. Most of the time, we're shooting for max leverage for most of our clients in that 65 to even sometimes 70 range. We're sizing some multifamily right now at 70, even 75% LTV across the country, Tennessee, Florida. So that was the biggest attraction for her was rate and the overall structure. Recourse in this scenario to her didn't matter. She's going to pay it down so quickly, and she doesn't have a lot of debt, a full recourse on her balance sheet. So she wasn't concerned with 560,000 on her PFS as a liability. And when we get the appraisal back, I'm assuming, haven't seen it yet, we'll be very close to dark value, which to me almost means she has no risk. Does that answer?
Makes sense. She was rate sensitive and the structure was the issue, basically. Makes sense.
And again, her request was, I want to pay this down as fast as possible, which is out of the ordinary for sure.
So, Will, for the single tenant properties, are you still underwriting with the market vacancy, or you mentioned something that was not clear?
It depends. So I would say we are typically underwriting to 95%, even though if it's single tenant, it's either 100% or zero, right? But we are taking some vacancy just to shock it a bit. But in reality, it's either, as a single tenant, it's either 100 or zero. You can't have occupied a single tenant building.
Right. If it's shopping center, different story.
Shopping
Then
center,
you have complications with anchor tenants, different contractual agreements between tenants there, that heavily factor in vacancy at that point or general occupancy. But yeah, for single tenants, like Will said, it's one or the other.
Yep.
Can I ask a question about collateral? Go back ahead a step. So on a ground up development project, what are folks using as collateral to cover the debt?
Yeah, so collateral is obviously the land. And then typically with ground up developments, they're always full recourse. So they always have a completion guarantee. So I would say in this case, while this term sheet does say it's full recourse didn't really matter here as much to the lender. And because borrower didn't care, they wrote it in as full recourse. She had zero concerns with it. She's like, yeah, it's fine. I don't care. But in a construction deal, it's very, very heavily weighted to the sponsorship and how strong they are financially, what their background is, how many completed deals they've done. We dig extremely deep into the borrower side, where this deal is triple net, really strong guarantee on the tenant side. It mattered less. So I would say the stronger the cash flow, the stronger the collateral, typically the less important the sponsorship is. Not always the case, but most of the time that's the case. The less cash flow or the weaker the deal, or higher risk the deal is, the more the sponsor matters. And the stronger the net worth needs to be, the stronger their resume needs to be. And it doesn't have to be just them. If they have a team, we often do deals where there's 3 or 4 individuals that each one has a specialty that's bringing value to that group. And as a whole, they're very strong.
Mm-hmm.
And Matt, my experience as a banker, also, if they have any pre-lease and maybe some of the tenant strength can help as well in the development side.
Of course. Right. So the more risk you take away for a lender by pre-leasing, by showing a lot of interest on that side, the easier they are typically to get done.
Perfect, guys. I want to open it up to questions. We're kind of at the end of the term sheet and the end of of the kind of bigger fish to cover in the on the general side of things. But if we just want to continue rolling until 11 o'clock here, just questions, be happy to answer them.
Couple questions. I know this is all about debt, but are you also brokering equity, or is that a different team?
We are. I would say equity today is a lot harder than it was. And we typically don't take on equity requests for our new sponsors, mainly because our job with equity requests are to sell the sponsor. Yes, the project has to make sense. Yes, the numbers have to make sense. The biggest factor with equity is the sponsor someone that the equity wants to get behind, right? Is their story strong enough? Do they have a good resume? Of course, the project has to make sense. So I would say we take on 3 to 5 a year, so not a lot. For that exact reason.
And follow up on that, are you seeing more lenders saying no to pref equity, when they're structuring the deals, or that's the same?
I wouldn't say we're seeing less say no. We're just seeing less work. So adding pref equity to a deal obviously eats cash flow, and it needs returns. And so deals are tight, most of them are. And so when you add pref to that, it makes it very challenging. Where I would say 18 months ago, couldn't do enough pref. I mean, the most pref I've ever done in my whole career. Every deal almost had it on the multifamily side, especially.
And Will, what would you say 2 years ago, the ratio of multifamily to everything else as opposed to right now? What would you say that we're closing?
Sure. Yeah, so I would say multifamily in general, again, we're a national team. Yes, we're in Dallas, so we do a lot in Texas. But multifamily has really hit the brakes, as I'm sure if y'all invest in multifamily, understand that, have seen that. Right? There's a lot of deals that have been sitting in the market that are typically priced still too aggressively. I would say buyers and sellers are getting closer and closer as the weeks go on. And as rates sit high longer, that will continue to happen. Sellers and buyers will meet, especially sellers that need to sell or want to sell. But yeah, we're doing a lot less multifamily than we were 2 years ago, where 2 years ago it was a big percentage of our portfolio. And I would say most of the time it just doesn't make sense. I think it's making more sense now as time goes on, but self-storage is also included in that. I mean, I would say self-storage cap rates across the country are softening a little. I have 8 deals that I'm invested in on the self-storage side. We're selling 2 of them. Cap rates are moving a little, but I would say still because of those cap rates on the self-storage side, it makes those harder because some of them are negatively levered, and a lot of them are tertiary or secondary markets where you're getting higher rates, less amortization, which obviously is not as attractive if you're trying to cash flow.
Are you guys doing any pre-qualification or pre-approval, or especially for brokers here? We are working with newer groups and without a property identified.
Sure. That's a tough one. So legally, we don't do pre-approvals. What we do is we will kind of sit down with borrowers and we'll look at their PFS, we'll look at their resume. We will get a very healthy file together, and based on their net worths and their liquidity, we will suggest a price range they should stay within. We do that very often, but most lenders will not give you a pre-approval letter for commercial. The property matters too much. The collateral is a very important piece, where unlike residential, right, most of, if not all of the issue or the strength is the borrower. In this case, specifically to this term sheet, the collateral and the tenant and the location, which was a fantastic location, mattered so much that without that collateral and that piece, the sponsor wouldn't have gotten nearly as good of terms because she had some complications that she brought to us. And so it's definitely the whole combination of both. But in a perfect world, if you have an awesome tenant in a great location with a great lease and a great borrower that's also strong, those deals almost always get done today. I think for us, the magic happens when someone comes to us with some complications and we have to go put it together and make it work.
All right.
So I was gonna say that questions kind of along the same line, but let's talk about, the recasting of loans. and a lot of properties going into foreclosure. So, kind of how does underwriting look for those types of deals, and the best way to kind of move forward on the lending aspect, either for your clients or yourself?
So how to find them or how to restructure them?
Restructure them and kind of underwrite the foreclosure deed in lieu properties.
Okay. So restructuring them, obviously we can only speak to what we're doing. Most clients come to us when they have a renewal coming or a termination of their loan that's maturing. And we will approach the lender directly. Usually it's a Zoom call like this, or if they're local, we'll go see them and we'll talk through it. We'll talk through, hey, this deal's maturing in a year. Or 6 months from now, here are the complications that we're seeing on the property level side or wherever the complications are. What can you as a bank, where can you move? Are you willing to write down some of the loan? Are you willing to, if the borrower brings more money to the deal, extend for 5 more years? Where does your credit team feel comfortable budging? And it's different for every lender. And I apologize, the ex-banker on here. What was your name?
Steven.
Steven, thank you. I'm sure, as you know, your bank or your past banks all have different qualifications of where they'll move and where they'll flex, and other areas where they will just not at all. And every bank's different, and you just have to find where they're willing to move. And if the parts where they're willing to move also match what the borrower can do or is willing to do, then you typically have a deal. I would say right now, multifamily on the bridge side, a lot of lenders are taking deals back, and because borrowers can't make the payments. So in that scenario, there's not a lot a bank can do or will do. If you can't make the payments and they've worked with you for a little bit, then I would say we're at a point now in the market where lenders are taking deals back. 12 months ago, that was not as true. Lenders were pushing, they were allowing more time. They were giving extensions when even on non-payment things, non-payment items, but overall, I would say that's not true anymore. In regards to finding them, and financing a foreclosed property, most of our sponsors that bring us deals like that are bringing us deals from the bank. So either we have a relationship with the bankers and they've come to us and said, hey, we have some deals we need to get off our books. Can you help us? Do you know any buyers? That happens. Or brokers that are good friends with bankers or have done workouts for them, we'll put them on the market for them. We're seeing a decent amount of multifamily in the Houston market especially, where bank-owned properties are on the market like right now. So you can dig a little bit, find who the owner is, and you'll find out that it's a bank. And you'll go, okay, cool. This is on its way. You also usually means that banks are willing to work a little bit on the pricing, especially if they want to get it off their books. There's a handful of lenders out there that also have good asset management teams already in place, and they usually hold them and try and get top dollar for them. But I would say that's more the exception than common that we see in our world.
Well said, Will.
Hey, Will. I know that things were tough, and I'm not here to to keep pounding on the same issue. I'm just trying to learn what is the play here. Even if we were looking at some of the triple net deals, but some of the deals with the current market terms, we can barely make mortgage payment on that, and there's no cash flow. So obviously investors look for cash flow. So if there's no cash flow, no cash on cash, what incentives left that I'm not seeing and others are seeing today?
That's a tough question because every investor has different goals and looking for different returns. But I would say most of the deals that come to us that are cash sensitive or want cash flow, for example, we're looking at some government lease deals that are 8-9 caps, and our rates are 6.5, right? So there's a lot of extra cash flow on that deal. Now you may not have interest in those type of deals, and if you're chasing mostly self-storage or multifamily, depending on the market you're chasing in, it still may be too aggressively priced. And I would say most of our clients that are chasing assets so aggressively priced are sitting on their hands. They are making offers, they're trying, but they're typically too short on the offer and they're just not being accepted. But I think that will continue to change because we are starting to see it, right? We're starting to see deals that we've quoted 3 or 4 times for 3 or 4 different buyers over the last year. That pricing is going from 21 to 18 to 17. There's a portfolio of 5 apartments, small apartments, here in Texas that I'm invested in. And it was on the market for about a year. Pricing kept coming down. Started on the market like 23 million. We're getting it for 14. So I would say 14 million per door is similar to pricing back in 2013, right? So on a per door basis. So there are deals out there if you just keep searching and you know the right people where you can get a very good deal at a very healthy basis. It's just finding them, I would say, is the hardest part.
Yeah, TJ, as an investor myself, just say, you've got to be patient and be disciplined to what your requirements are. And some folks that aren't patient will start chasing, well, maybe this property will turn and it will appreciate and try to speculate on value in the future. And that's where you can get in trouble because they don't have the cash flow to support it during the meantime. And then they're back a couple of years later trying to sell it at a loss. So just be patient and be disciplined.
Yeah, I would say to add to what Steven said, I would say a lot of times we see issues when we see borrowers' models and their exit cap assumptions are, a 4.5 or a 5 cap. And they're doing that to make the numbers look good. But that is just very risky. Obviously, I don't have a crystal ball. I don't own one. I wish I did. But you have to be conservative. And if those conservative numbers work for you and your goals, and if you have investors, obviously their goals, then you go after it. But yeah, being patient, I would say, is the best skill right now that you can have, which I am not patient at all. So that it's hard. And a lot of investors, a lot of individuals that buy deals aren't patient people. That's just how they're built, right? They're usually go-getters. So it is counterintuitive, but I would say that's the best skill you can have currently.
Hi, William. This is Wade Wright. Do you guys do financing on seconds? Let's say there's a underlying seller carry first at a really low rate for 5-7 years. If you do, what would the rate and terms look like on that?
Yes, not as often. I would say if you have seller financing on the first, that makes it easier. Most lenders, as you can see in this term sheet. Hey, Bryce, can you scroll up a little bit?
Yeah.
Excuse me. That's good. There you go. So junior liens towards the top, they won't allow any seconds in this loan. Again, leverage wouldn't really allow it anyway. But if we have some clients come to us and say, hey, I need 65% senior and I need another 10% second to get us to a total of 75% LTV, we'll bring the 25. Is that possible? The answer is absolutely, especially with seller financing. Most seller financing, they allow a second. And they're just not as sophisticated. They don't care typically as much. The mez loans we're doing, or second loans we're doing, are expensive. And usually they're larger deals. Most second lien lenders are not going below $1 million for the second piece, which means the first piece has to be pretty large. Again, I don't know what sets deals you're chasing, but most of our mez lenders start at $1 million, and they'll do anywhere from 5 to 15, maybe even 20% of the stack. So if your senior's at 65 LTV, they'll do maybe 15 to 20, we'll just say for this example. So then you'll bring as the investor the rest. But I would say it's typically only working if you're doing seller financing on the first. Most senior lenders, more traditional lenders, don't allow seconds and are not excited about them. I would say there are exceptions always to almost everything we're saying, but on a whole, that's the case.
Thank you.
Awesome. Thanks so much. We want to really appreciate Bryce and William for coming today and providing us all this information. I know that there's This is definitely a super important piece in our industry right now. I mean, without the loan, you're not going to get a deal done, and the debt is definitely controlling a lot of the success right now in our deals. So, a question came up about a replay. So just to remind everybody, yes, we do have the YouTube channel. It's not immediate, but every once in a while, just go in and check that. It's usually the week later. Bryce and William are available. I just wanted to ask you guys really quick, kind of what's the best way to not necessarily to get in touch with you, like when is the best time when you guys encourage brokers or clients to be getting in touch with you? And what can we do for you guys?
Sure. I would say when is when you're awake. And when we're awake, we don't really stop working. It's all you're on and you're off. I take breaks during the day, go work out, spend time with my family at certain times of the day. But yeah, it never ends. So you can get us on our cell phones via email. I think both of them are in the chat feature here. We're always available, and if we're not, text us. We'll get back to you usually within 10 to 30 minutes.